In November 2025, we are witnessing one of the most dangerous moments in modern financial history. The stock market just lost $450 billion in Nvidia's value over 3 trading days, and this after the company announced record-breaking earnings of $57 billion in quarterly revenue. Think about this paradox. For 2 years, Nvidia has been the atlas holding up the entire technology sector on its shoulders. But now, a Bank of America survey reveals that 45% of fund managers identify the AI bubble as the single biggest threat to markets. That number was 33% just 1 month earlier. The S&P 500's price-to-earnings ratio sits at 29.5. Roughly 90% above its historical average. Even after spectacular earnings, Nvidia's stock trades 15% below its October peak of $212 per share, around $178. The rescue party is over. Nvidia can no longer save this market. Nvidia's market capitalization reached approximately $3 trillion in October 2025. That's larger than the entire GDP of the United Kingdom. At this level, Nvidia was trading at roughly 13 times its annual revenue. To put this in perspective, Apple trades at about 8 times its revenue. Amazon, even during its highest growth periods, rarely exceeded 5 times revenue. According to JP Morgan's analysis, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, 90% of capital spending growth since ChatGPT launched in November 2022. This is not a diversified rally. This is concentration risk on steroids. Nvidia grew revenue 62% year-over-year in its most recent quarter. That's remarkable for a company of this size. But sustaining 60% growth on a $3 trillion market cap means adding $1.8 trillion in value annually. That's not going to happen, and everyone with a calculator knows it. In November 2025, Nvidia reported results that beat analyst expectations across every metric. Data center revenue, $51.2 billion, up 66%. Guidance for next quarter, around $65 billion. In a rational market, that would have sent the stock soaring. Instead, it dropped 5.5% that week. The Nasdaq fell 3% in the same period. Why? Because the market has finally started asking the right question. How much future growth is already baked into this price? The answer: way too much. Let me explain something that should make every serious investor deeply uncomfortable. This is what I call the Great AI Financing Circle. How it works. Nvidia invests $100 billion in OpenAI. OpenAI commits to buying Nvidia chips worth hundreds of billions. Microsoft invests in OpenAI and buys massive amounts of Nvidia chips. Microsoft also invests in CoreWeave, an AI infrastructure company. CoreWeave rents computing power to OpenAI using Nvidia chips. Nvidia owns equity stakes in CoreWeave. You see the circle? Money flows from Nvidia to OpenAI, then flows back to Nvidia through chip purchases, while Microsoft funds multiple players who all buy from Nvidia. Michael Burry, famous from The Big Short, recently wrote on X, "True end demand is ridiculously small. Almost all customers are funded by their dealers." In business, we call this vendor financing, and it was always a red flag. The alarming numbers. A Yale School of Management analysis revealed that AI-related capital expenditures surpassed consumer spending as the primary driver of U.S. economic growth in the first half of 2025, accounting for 1.1% of GDP growth. When a single industry's capital spending becomes a measurable percentage of national GDP, you need to ask serious questions about sustainability. OpenAI, the unsustainable model. Despite its $500 billion valuation and the hype surrounding ChatGPT, OpenAI is losing billions of dollars annually. Its projected revenues for 2025 are around $13 billion, but it's committed to spending $60 billion per year on computing power with Oracle alone over the next 5 years. This is not a sustainable business model. This is a company burning through cash while hoping that someday, somehow, the economics will work out. Oracle, the hidden losses. The CNBC report about Oracle is particularly telling. The company expects to lose considerable sums of money renting data centers primarily to OpenAI, having already incurred a $100 million loss in its most recent quarter. Think about that. Oracle announces a massive deal with OpenAI. Its stock soars 40% in a single day, adding nearly $1/3 trillion to its market value. But the actual economics of the deal aren't profitable for Oracle. That's not investing, folks. That's speculation masquerading as business strategy. What we've already seen. I've lived long enough to recognize when markets lose touch with business fundamentals. 1960s. The Nifty 50 stocks traded at any price because growth was assumed to continue forever. Late 1990s. Internet companies with zero profits commanded multi-billion-dollar valuations because they had eyeballs and mind share. The dot-com crash taught a crucial lesson. Being right about the technology doesn't mean you'll make money as an investor. Pets.com was right that people would eventually buy pet supplies online. They were just 15 years too early and priced as if the future had already arrived. Dangerous concentration. When markets become dependent on a single company or narrow group of companies to maintain their momentum, they're already in trouble. On November 20th, 2025, despite spectacular earnings, Nvidia's stock fell 3.2%. The Nasdaq dropped 2%, the S&P 500 declined 1.56%, and the Dow lost nearly 390 points. This disconnect should tell you everything you need to know about where we are in this cycle. The fear indicators. The VIX Volatility Index jumped 14.2% to hit the 20 level. CNN's Fear and Greed Index plunged into extreme fear territory. Declining stocks outpaced advancing ones by more than 3-to-1 on the New York Stock Exchange. The extreme valuations. S&P 500 PE ratio, 29.5. You're paying $30 for every dollar of current earnings. Schiller PE ratio, 39.2. You're paying $40 for every dollar of inflation-adjusted 10-year average earnings. Both metrics are screaming that stocks are dramatically expensive by historical standards. The only other time we've seen valuations this stretched was right before the dot-com crash. The collapse pattern. From 70 years of observing markets, here's what happens when markets run out of saviors. Phase 1: denial. Investors see warning signs but convince themselves that this time is different. They point to genuine technological advances to justify valuations that make no mathematical sense. Phase 2: the confidence crack. It usually starts with one bad quarter or one piece of unexpected news. The specific trigger doesn't matter much. What matters is that once confidence cracks, it spreads quickly. Phase 3: the repricing. This is where it gets ugly. When investors simultaneously realize they've been paying unsustainable prices, they all try to get out through the same narrow door. We're seeing early signs of this pattern right now. Why this time is different is wrong. The common argument. Warren, you're missing the AI revolution. These companies have real earnings, real cash flows, real business models. The reality. You're partially right. Today's tech giants are far more profitable than the dot-com companies I avoided in the 1990s. But profitability doesn't insulate you from paying too much. As I've always said, price is what you pay. Value is what you get. And right now, the market is paying record prices while the value proposition becomes increasingly questionable. The most dangerous words in investing. This time is different. It's never different. The details change, but human psychology and mathematical reality remain constant. And right now, both are telling us the same thing. We're paying too much. We're hoping for too much. We're depending on too few companies to deliver miracles. My recommendations. My advice remains what it's always been. Focus on businesses you understand. Never pay prices that require miracles. Maintain adequate diversification. Remember, your goal as an investor is to compound wealth over decades, not chase momentum over quarters. The golden rule. In 2008, when financial markets were collapsing, I wrote an op-ed for the New York Times titled, "By American. I Am." That wasn't market timing or heroism. It was simple recognition that prices had fallen to levels where value exceeded price. Today, we face the opposite situation. Prices have risen to levels where they significantly exceed any reasonable estimation of value. Conclusion: gravity always wins. The market might continue rising for a while. Speculation can persist longer than logic suggests. But gravity always wins eventually. When markets price in perfection from Nvidia and the handful of companies surrounding it, they set themselves up for disappointment. And when that disappointment comes, not if, but when, those who paid premium prices for speculative growth will learn expensive lessons. The final word. It's better to miss out on gains than to participate in losses. Stay safe out there. And remember, a pin lies in wait for every bubble. And when the two eventually meet, a new wave of investors learns some very old lessons.